Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, with John Mousseau, CEO and Director of Fixed Income at Cumberland, with you for the second time this week. That's normally not a good thing. That means there were some things in the market that needed to be discussed midweek. We had a Wednesday video. If you weren't able to take a peek at that, I invite you to visit the website, the link, or our YouTube channel, which if you sign up for, you'll get our videos whenever they come on. Classic fear in the market yesterday. Yesterday was Thursday. I mentioned a couple of times in conversations with clients, we saw the equity-only put-call ratio spike to 128. The third time we've creased one this week. I tried to do some back work on that. I believe that's unprecedented. I remember multiple times in 08 having to need a second move through one on that equity-only put-call ratio to get a little bit of a relief rally. We saw it today. We'll see how that expands or contracts next week. But I mentioned the fear, and it wasn't just fear in equities. There was fear in all asset classes yesterday. We saw money flying out of fixed income, equity, and commodities. John wanted to touch a little bit about what he's seeing in the bond market.
Thanks, Matt. What we saw today was really different than what we saw earlier in the week. Earlier in the week, we saw a rush into Treasuries, lots of volatility because of the Saudi oil selling. And what you saw was an erosion of liquidity in all of the bond markets. Munis, corporates, mortgages, high yield we know got absolutely crushed. And a lot of that was driven by people trying to run away from risk. And even in the muni market, what you saw was lots of bond funds selling, and you saw it into a very illiquid market because the dealers couldn't hedge with Treasuries. So it was a very, very tough week for bonds in general. Today, Treasuries continued to back off. That's a good thing, in our opinion. The 10-year Treasury went back to about 1%. In the middle of the worst time this week, it was down to 0.3. Muni bonds, more liquidity today, a little better. Corporate bonds, a little better. High yield today, a bounce back. Does this make a trend? No. Is it a reversion to the mean? It's a first step. But what it does here at Cumberland is it allows us some maneuvering in the bond world to get some yields that we haven't been able to get in 6 or 7 months. We don't know how long this is going to last, but we're going to try to do what we can. But we're also drilling down on credit because we don't know what the new normal might be for the next few months as we try to get out of this coronavirus. So things that you thought were essential services may not be that essential in a new world. Think like a subway or an airport, etc. Eventually they will be. But what you try to do is drill down and make sure that credit is better than it was before and try to improve credit because it's going to take a while to come back. But we're encouraged by what we saw today.
We have 3 words we use in fixed income in our research meeting and on our calls on Monday morning, and it's credit, credit, credit. That's what drives the process on our fixed income research and our modeling and strategy at Cumberland. Equity side, spoke on Wednesday. What can we do to take advantage of some of this volatility? I'm not saying that we can't go lower or we can't go higher. Volatility. I think we have to continue to consider or actually bid under the market. Let that volatility come to us. You're having swings intraday in the equity market in many securities of 5, 7, 10, 12%. Don't chase equities here. Bid, let them hit you. Make sure you want to own the security. Make sure 3, 6, 12, 18 months out, you're comfortable owning that security. Some of the names we've talked about in the past are still the same names. We still want to lean on relative strength. the areas that performed best going into this dislocation, and that's what it is. A down 25 in 16 trading days is a dislocation. Fastest dislocation, fastest drop of that magnitude from all-time highs ever by 2x in speed. Caught a lot of people, including myself, flat-footed. Keep in mind, in tactical trend, which I primarily manage, we had gotten up to 23-24% cash coming into February. Normally plenty of cash to ride out a little bit of a storm. Not enough here. We've been nibbling on the way down through the last 10 days. We'll see how those prices end up with some very strong relative strength names. Pull up your best movers today. That's your list. Pin that list, the top 20 best movers today, to your computer. Review them. Do some work on them. You'll see we own some of those names. You'll see that many of our ETF index plays are heavy in those names. And you know what the names are. Names like Microsoft, names like Apple. Don't ignore Adobe Systems, which comes out last night with a beat and says, you know, going forward, we're going to have a little bit of pressure, but doesn't look too bad. I mean, stock up 17% today. Now, keep in mind, it's down from where it was in mid-February, but not nearly what the market's down. That's what relative strength is. Keep an eye on it. Also, nice day today, air back in the balloon, only gets us to a down 8 or so on the week. Let's not jump ahead and get overly excited. Just like when the market's in trouble, we talk about remaining level-headed. Level-headed, reasonable entries, reasonable goals on exits and paring back. Maybe this becomes more of a trading market versus a buy and hold. We'll see. The market will dictate that to us. Let's not try to outguess it. So let's see what the weekend brings. Weekends have been fireworks here in the markets here as well. We'll see everybody next week. We may do an intra-week video or call again. Look for us perhaps midweek to let you know how we are seeing the markets. If everything's calm, we'll see you next Friday. Have a great weekend.